Okay, so measuring and monitoring volatility, which is the third chapter um, in the VRM book, and that is where it is an extension of somewhat a concept of the VAR. It tells you something about its weakness, and then the majority of the discussion will be around volatility, which is the second half of it. Monitoring volatility is more important in this part than measuring volatility. Okay, because measuring volatility is somewhat a repetition of what you have understood from return calculation as well in either this chapter, either the previous two chapter, or a little bit from your um, from your quants book itself about returns. So majorly the focus is going to be on the volatility monitoring. Um, Having said that, the chapter begins with a discussion on value at risk, which we all understand it by now. It is actually a one-sided tail test which is giving you what would be the chance of the loss breaching a particular threshold limit within a particular time period and with a certain defined confidence level. If I talk about VAR being $10,000 with 5% daily VAR, that means on an average, I'm saying that the losses will be under $10,000 on a daily basis, and it would be breached only 5% of the time. That is what is meant by VAR. It is basically VAR has three methods, as you know by now. The most important method, which is the normal distribution based method, or what we call it as covariance variance VAR as well, or what we also call it as the normal VAR, is basically coming from a normal distribution. That is where we have made a very solid assumption, and you might have seen the formula by now, that the formula goes like this: plus minus standard deviation and then the Z. Of course, we know it. We are talking about only the one-sided deviation, so we'll just take it minus. And var is always a negative number because you're looking at the negative side of it. Even if we don't put any sign to it, there could be a chance this mu is taken as zero certain times. If the information is not given, then you talk about the mean return being zero, and then we focus only on this part for calculation of var. Sorry, calculation of var. Just like the standard deviation can be adjusted, a var can be scaled up, can be scaled up or down, just like your standard deviation can be scaled up. So that means a monthly figure can be converted into an yearly figure, an annual figure can be converted into quarterly, quarterly can be converted to daily, daily can be converted to monthly, so on and so forth. So there are ways through which you can scale up and scale down the var number. And why can that happen? Because var is basically using your standard deviation, which itself can be scaled up or scaled down. And of course, when we talk about mu is an unbiased measure. That means it can be anyways. It's not going to be different from for sample as well as for population. So that's the reason you can basically scale up the var in a similar way as you can scale up the standard deviation. But the underlying assumption behind this particular method is that you take your distributions to be normal distribution, a normal distribution. That means times are actually normal. You're talking about no stress kind of a situation. Economy is working just fine. There are no major hiccups. There are no major economic crisis, no wars, nothing happening. And these are almost the normal times. However, when we look at, you know, some of the things that basically are not working in a realistic world, those particular three things are, which you'll find it in your daily life, is first is the data is actually fat-tailed for a period. Second thing is that they could be skewed. And the third thing is they can be unstable. Let's talk about all these three things. What do we mean by fat-tailed? Fat-tailed means if I look at like last 10 years of data, there are now two wars that we are dealing with. There was a COVID in between, and there are other things that happened. So all of these are outliers, and the outliers are the ones that causes the tails to be fat in nature. Okay, because these are outlier events. I mean, When was the last time we saw a war? I don't know. Even before that, Russia time and Israel time. When was the last time we actually saw a war? So these are all outlier events, and that is where we call them as fat tails. And this is more realistic scenario that we are talking about. So a normal distribution is an assumption that everything is working normally, but in real life, when we look at the data, things might have happened, events might have happened. Um, and that's where things are not as normal as we would want it to be, given that we have taken the data. The second thing is skewed. When you look at things, skewed means that they are positive or negatively skewed. So data can look like this, or it can look like this. And skewness is a big problem, because we understand, again, when it comes to skewness, there are either a negative outlier or a positive outlier, which causes this problem. So in real life, when we have data, we have skewed distribution. We have skewed distribution and not a normal distribution. And the third problem is unstable. What do we mean by unstable here? Times are changing. Okay, times are changing is what is meant by unstable. So if you look at the period before 2019, we were all going through a good kind of momentum. Then there was COVID, then there is war. And before even 2018, there were different kind of crises that happened. So the point here is economy is basically, or the global economy is facing new sets of challenging challenges every year, which causes an increase or decrease in the volatility at different points of time. So if I were to take, let's say, last 10 years of data, to predict for the next 10 years of data, I can't do that, because I have to be certain about the period. The period in consideration for the future forecasting should not have any kind of fat tail data. Extreme events nahi hone chahiye. And nahi hone chahiye, that means the skewness should also be controlled. That skewness should be normal. Like skewness should be zero, no extreme positive, no extreme negative. And the third thing is the data should be stable. That means too many things which have caused the volatility to suddenly increase and decrease should not have happened. Like the moment we all of us went for a lockdown, it's a sudden kind of a volatility you know um, kick. It was a sudden kind of a volatility issue, because there was then a lot of uncertainty, right? So think of it this way, the regimes, the economies keep on evolving, and now we are talking about theoretical data against realistic data. So what we consider theoretically is a normal distribution, saying that things are going fine, but realistically there are challenges, which wherein we have a fat tail, we have skewed, and we have unstable data. Connecting it back to the quants book where we studied that when we use time series, we need to first take care of removing any kind of outliers by using the Cook's test. This is exactly why we need to do that, because the realistic data has fat tail, it is skewed, and it represents the unstable times as well. So what are the ways around it? How should we um, how should we tackle for the unstable part? Fat-tailed skews, we understand. We need to get rid of the outliers, consider an appropriate time period data, so on and so forth. But when it comes to fat tail, or when it comes to the unstable part, for the unstable part specifically, because this is something which is beyond our control. Times are changing, but when we there are times when we need to take a longer term forecast. And how do we fix that? We can fix that by using two types of distribution. One is called as, and that's where when we evaluate the data, we have to be very, very cautious of what data we choose. So there could be two types of distribution in real life when we take like last 10 years of data distribution. One kind of distribution is something which is called as unconditional, unconditional distribution. And the second kind of distribution is a conditional distribution, conditional distribution. Okay, when we talk about unconditional distribution, that means things are not changing. They're unconditionally valid. They are unconditionally valid in the last 10 years. That means things have been working smoothly. Volatility or standard deviation in the economy has been relatively stable. Everything was smooth throughout the period and things are more or less stable. But when it comes to conditional volatility, that means the volatility is valid only for a particular time period. So if you talk about like, let's say 10-year period, I would say that the volatility was here first. Volatility was here first, then the volatility increased for some time, then the volatility decreased for some time, then it was here, then it became here, then it became here. so on and so forth. So with every passing few years, the volatility is suddenly shifting. It is suddenly shifting. So that is where we'll say the volatility is, or standard deviation is, kind of unstable. And that is where we'll just not have to take the data in entirety. 10-year data ko ek saath mat lo. You'll have to either find a way where the data keeps on adjusting for the volatility, or you'll have to break these down into phases. So when we evaluate the period, how do we evaluate the period? It was pre-monetization, pre-demonetization, post-demonetization. It was pre-GST, post-GST. It is now pre-COVID, post-COVID. All those things have become more common in these days because the level of volatility has gone for a sudden shift up and down both ways, quite a lot. And that is where we consider them as phases, right? So that is where you'll have to be very, very clear when you talk about distribution and talking about a var number, what kind of distribution you want to focus on. Whether it should be unconditional, that means things have been pretty much stable. Wherever they were pretty much stable. Or it could be conditional distribution where the level of volatility was adjusting up or down in a certain fashion, and that is where it's considered unstable. And the volatility is going to be considered constant only depending on a certain condition, only for a certain period, and that is where conditional. So conditional means unstable. Okay, because it is changing, that is where it is called as conditional. Unconditional means things were relatively very, very stable. Okay, so if the means and assets, and that goes not just for the volatility, but for the mean as well. Let me make a note of it. Mean and volatility or standard deviation are pretty much stable. Volatility or standard deviation were pretty much stable. Mean and volatility. Because in real life, these things aren't stable, aren't that stable at least. So that is where it's important for economists to account for them. And what happens if you take like a conditional data as the building block for var? Then you will see this fat-tailed and skewness event. So that is where if you take an unconditional event, you will not have any of the three problems, being it fat-tailed because you do not have outliers. So if you don't have outliers, there won't be a skewed data and the times would be more stable. But if you take unconditional data, you'll have a fat tail in your data, you'll have skewness in your data, and the time of data it is representing, it's also going to be unstable. And that is where they say that you need because times are more conditional distributions, like realistically, that is where you need a regime switching model. That is where they talk about a regime switching model. So let's understand, and it's only theoretically that you'll have to cover this topic, regime switching model, which is associated with the changing time conditional distribution. So in modeling data, it is only assumed that volatility changes slowly. Volatility usually changes slowly. This means that the high volatility is often followed by high volatility period and low volatility by the low volatility period. So because it's difficult for volatility to change, and it changes very, very slow. But in real life, we know that the volatility shifts are quite high. The moment Israel declared a war, the volatility is high. The moment Lehman filed for its bankruptcy, it is high. The moment Russia declared a war, it is high. The moment COVID was declared a pandemic, it was high. The moment demonetization happened, the volatility was high. All these are situations in which the volatilities basically suddenly adjust one another, and it is not slowly adjusting in nature. That's where we say, however, the volatilities may also change quickly and abruptly rather than slowly, wherein our models do not adapt themselves very, very quickly. And when this happens, we often have to refer to a regime switching method, wherein it will take for a few years, it will take, let's say, low volatility, then it will suddenly shift to a higher volatility, sudden a drop volatility, then again a small rise in volatility, again a rise in volatility, again a very small rise in, and again there is a huge drop in volatility, so on and so forth. So our models should be adapting to the changing level of volatility. And that is where we should not be considering one volatility level for the whole calculation, uh, except when we believe that the data is more conditional. Okay. Now, there are other ways to understand the same thing. When we talked about conditional and unconditional, This is something to do with your concept of covariance stationarity, as we understood in your quants book as well. So when you talk about conditional, things are as good as in the past. Okay, this was conditional stationarity. Sorry, this was covariance stationarity. But when we talk about conditional, that means there is no covariance stationarity. Even in terms of time series, if you think through it, then we are talking about unconditional being covariance stationary. Things are pretty much the same way as they were in the past, and you can use futuristic data for the same. But when we talk about conditional data, that means things are changing. You cannot simply use the historic data to forecast for the future. uh, then we come to parametric and non-parametric var method. So let's just first talk about what is parametric and non-parametric term. Parametric, non-parametric. And this definition of parametric and non-parametric here that I'm going to explain to you is just not valid for var. These are two specific statistical terms which can be used for anything. Parametric means when you assume something of a model and then you believe you are going to pass some data or some assumptions through it. You are considering those parameters. So when I say that I am assuming that the data is normally distributed with a mean of, let's say, 6 and a standard deviation of 2. I am first assuming that my data looks like a normal distribution. I have made a very strong assumption there that my data looks like a normal distribution. Then I'm passing some parameters there saying the mean of the data is 6 and the standard deviation is going to look like 2, which might not be true, but I need a building block to start with in my model. That is where these are parametric models. Parametric model, that the returns calculated, the series calculated, or a parametric based, right? A non-parametric one says, let's just take the real data, whatever it is, dirty, however dirty it is, however unstable it is. Let's just take that data and plot it like a distribution. And that is a non-parametric data. You're not assuming things are normally distributed. If a data looks like log normal distribution, if it looks like exponential distribution, whatever distribution it looks like, we'll just accept it the way it is. We'll just take historic data as it is in its clean form, or as it is in its raw form, not clean form, but as it is in its raw form, and then put it under the distribution, and then we draw the distribution there. And that is what is going to be non-parametric. You're not making any assumption on the mean. You're not making any assumption on the standard deviation. Whatever comes out of this raw data would be the mean and the standard deviation. Even if the mean, uh, sorry, should be mean here. Even if the mean and standard deviation looks far, far apart from the one which you have calculated through a parameter, let it be. So when we use historical data to forecast on things, that is where things are more non-parametric. Historical data, historical data. When we are using historical data without any adjustment, and that is what we are using it for, the forecasting and everything, that is non-parametric. But when we assume things to be normal distribution, mean, median, mode, certain way, that is where things are more parametric based. So of course, when we talk about the historical based approaches, wherein we have talked about how historical simulations can be used for considering the historical method, which is defined here. And I think you have covered it in your last chapter as well. That is where there are two methods that can be followed. Because in historical simulation, what happens? Historical simulation is a method under which you need to sort your historical data from descending to ascending order, right, like from to an ascending order, sorry. So it starts with like most negative values here, or you can do it the other way. It starts with um, the descending order as well. You can do it. So you start with the highest value, go to the lowest value, or you start with the lowest value, go to the highest value. And then you look at what data you want to choose, what types of confidence level you want to choose. If you're talking about 95 percent as a confidence level, look for the least five values. Look for the least five value, and the fifth last value there, that would be considered as your var number. That would be considered. So position of a data based on the order, just like we are doing it for mean, median, sorry, that we find out the placement of the data, and the value associated with that data is considered to be the var number. Similar things happen here when you're talking it in terms of either returns or a loss. See, last chapter, it was all about dollar loss being given. This chapter, they'll give you the loss in terms of return. So whatever data you have been given, be it in terms of a loss, in terms of a dollar amount, or that can be in terms of loss mentioned in a percentage amount. You'll have to sort your data in such a way that you pick up the least five numbers, the last fifth number, or the fifth number, which is least in nature, that would be considered as your var number. So if you look at this data, if you look at this data here, and that is where they have considered the lowest six numbers. If we were to take the fifth percentile, we'll just go like from the lowest to the last fifth, 1 2 3 4 5, and the answer is going to be minus 3.4 because of the placement, because of the placement. Okay. Now, an important point to note here, whatever historical simulation that we have done till now, whatever historical simulation we have done till now, it's all unweighted. Unweighted. At this point, I would also like to introduce the concept of weighted data. Weighted data. Now, what do we mean by unweighted data and weighted data? Let's say I took a data for last 5 years and considered that data to consider about the VAR number. That is truly an unweighted data where every item, where every day's daily return has an equal weight assigned to it, and I'll call that as 1 by lambda. An equal weight assigned. 5 साल का data यानी कि how many days? 360 into 5. 1800 days data, and we have given equal likely weight to everything, and that is where we have done a normal calculation. Weighted data, on the other hand, is a mechanism which is followed wherein we consider uh, that different weights should be associated with different time period. Okay, so let's think of it that way, that and connecting back again to the quants, because that is what I have actually taught it to you in quants. So in quants, when we consider auto regression and things like that, we say that the prices today are highly influenced by the prices of yesterday, then prices that exist 10 days back, right? That was the concept of auto regression, how a value is correlated with its own past value. And we believe that the recent data is going to have a higher correlation with my prices today or returns today than the prices of the returns 10 or 20 days back, and is going to have probably no correlation with the data, with the similar data of 10-year back data. That's exactly the way things are also mentioned, because we are calculating for this historical simulation a loss as a dollar or as a percentage based on the historical data only. So that is where one approach with that, where we take 5-year data has an equal weight, is a simplistic one. It's an unweighted approach, but then we have a weighted approach to it as well, in which we take the recent data to have more weight assigned to it than the other weight. So this topic of weighted data is now actually removed. Earlier, it used to be a part of an FRM, but we are going to discuss about one model specifically, which is called as MDE, which comes later in few pages. MDE, multi-density estimation, is one such weighted technique. There are other weighted techniques which are now not no longer a part of an FRM, so we are not going to talk about it. But the bottom line here is, when you talk about historical simulation, there could be two methods. One is an unweighted method where all historical items are being given equal weight, and one wherein there is some mechanism to put some weightages to the data that you have been given. And henceforth, when you look at this chart, specifically historical simulation weight, you see all these items, because there were hundred of items there, and everything has been given an equal weight, which is 0.01. So even if you multiply, that's not going to cause any difference. But when assume that when I'm giving like 5% weight to this item, 3% weight to this item, 2% weight to this item, 1%, 0.5, 0.25, 0.05, so on and so forth, in a different order, this value, or this sum total of the returns that I'll have to sort will also become different. Then I'll have to sort the weighted return. I'll not have to sort the normal return. I'll have to sort the weighted return to find out what the loss number should be. So that's a very important extension. Think of it like an extension to the historical simulation. Yet we are just focusing mostly on the unweighted part in this book. Weighted part has been removed, but you should just know that what you're studying is this, because this can be tested at least in theory. Now, when we discussed about how do we calculate for the historical simulation, it's also important to understand uh, that weighted or unweighted, both mechanism can be used for parametric return. Both mechanisms can be used for non-parametric return. Okay, and that is what parametric is based on certain assumptions, and that is where we mostly use the data coming from Monte Carlo simulation. Monte Carlo simulation. So we tell the system, we tell our computer that generate a certain series in which data should look like a normal. You should have mean of this much and standard deviation of this much. Combine it in this way, and that is where parameters Monte Carlo simulation is used. Whereas for a non-parameter, historical data is certainly something which can be used, and both can be used to generate a weighted return or a non-weighted return. So when you talk about parametric return, the equation that you see here, r by a r square or r cube and everything, this all is a way through which they're telling how the standard deviation has been created. Not that I want you to pay it any attention, because this is a simple formula that we have also been using, how the returns are being calculated. Okay. Now, the important point here is if we assume assets follow a random walk. Now, if you don't remember from the quants book, random walk is something where I say the prices for today is going to be, or the returns for today are going to be exactly the returns for yesterday plus an ad hoc component or an EDO component. Okay. That came only during last 2 or 3 chapters, if I recall. Okay, so random walk is something where the prices for today or returns for today are basically equal to the returns for yesterday plus an ad hoc unpredictable uh, thing which happens. So that is why we say if we assume assets follow a random walk, the mean return is assumed to be zero. Alternatively, an analyst may assume conditional mean different from zero and a volatility for a specific period. Mm, Having said that, just understand parametric and non-parametric in the way that I've explained it to you. That ways you'll not be getting any issue with that. What I also mentioned is a normal distribution is also called as delta normal var. We also call it covariance variance var. This is very or a normal var, which is very commonly used names for the same thing. This is where they have given like estimating for a conditional mean. Let's just understand what does it mean by conditional mean. Assuming k is equal to 100, you have 100 items in your data. Estimate the conditional mean using the market is known to decline by 15%. So if they are saying that the conditional means that the market is going to be down by 15%. So how do you adjust for certain things? So the daily conditional mean of asset return is estimated to be minus 15 bps per day. All he's doing is he's taken the 15%, which is a known market price for year. He has divided it by 100 days, and that's where he's getting the volatility on a per day basis. Okay, if this is the volatility for 100 days, what is the volatility for a per day basis? I don't think personally this example is very important, but at least you should have some kind of idea to it. For a non-parametric, he's saying historical simulation is one way, multivariate density estimation. The only method that we are going to study here is being mentioned here. So let's look at what are the advantages and disadvantages of parametric and non-parametric method. Advantage for a non-parametric method does not require any assumption. You can simply take the data. You don't need to make any assumption there, because making assumption means challenges that or overlooking some kind of information as well. So non-parametric data is something that you can populate, just fill in the historical data, things will be taken care of on its own. It might have fat tail, it might have skewness and other deviations, because all three things, in fact, fat tail, skewness, and the third thing that was there, which was unstable time. All three things might appear because you're simply using the historical data. The disadvantages of a historical data or a non-parametric approach is data is used more efficiently. It is more realistic in nature than being considered that this is ideally how the world works. And separating a full sample into different market regimes also reduces the amount of unstable data. So these are some of the advantages and disadvantages associated with parametric and non-parametric method. Not that important, I would say. Estimating the volatility and the mean reversion, which is our next LOS. It is somewhat an extension of the concepts that we already did while we were doing. Um, there is specifically a chapter. Yeah, defining returns and volatility. So measuring returns, volatility, and correlation. Reading number 23 from the quants book is, it's something like an extension. Its extended portion comes in the rest of the book here. So the first part is how do you calculate for the standard deviation. And when it comes to standard deviation or volatility, let's just say there are certain other methods, volatility or standard deviation. Okay, so think of it this way, volatility or the standard deviation, which is different from variance, which is not the same thing as variance, because variance is a name which I use for standard deviation square. So volatility, which is my standard deviation, can be predicted in a can be calculated in a certain ways. I can use either the historical data, which has like historical component to it, or I can calculate it via implied volatility. So what is the way through which volatility can be calculated? Use historical data or implied volatility. Just for the revision purposes, how is implied volatility coming into picture? It is basically coming from the reverse calculation of the prices of the real option prices. They come from the real option prices, or rather not use real option, but I would say current market prices, current market prices for options, price for options. So when you observe the current prices of the options which are trading in the market, you put that into the BSM model, taking all the other variables which you might have been knowing by now, or in fact not. In fact, this is a part of the same book which I'll teach you later. But think of it, this is a way through which, and BSM, just for your own understanding, is a model which helps you predict for the premium that are various associated with various options. So think of it, when you realize that the options are already sold in the market, then you reverse calculate and put these things back into the BSM model and calculate for a volatility. Now, BSM is a model which is based out of 6 things, which has 6 things for consideration. And all 6 things that are something that you have done in your FMP book. There is a standard deviation, there is a stock price, there is exercise price, dividend, and volatile, sorry, not time. And then there is um, the rate of return. So all these 6 factors are in fact the drivers for BSM that helps you calculate for the option price. Now, if you already know the option price from the market, you put that back into the model. All other information is given to you. Then you calculate for the standard deviation, and that standard deviation is called as implied volatility. Now, why are we calling it as implied volatility? Because this this is not this is not how it is working like academically. What happens, you have all the 6 information pieces of information, you put that into a model and you get a price, right? Here you are considering market to be appropriately timed and priced. You take all that information from the market, reverse calculate it, and find out implied volatility, which you are seeing is reflective of the real sentiments in the market. So it is more forward looking. When, let's say, the Israel war broke out just around 2 days back. So when it war broke out, of course it has a lot of major uncertainty, it brings a lot of uncertainty to the market. So the volatility might have adjusted. Now it's not going to be as it was 3 days back. And if the volatility has adjusted, there should be a way to capture it, because historical data is not capturing my instance where the war was declared. So how should I do it? I'll take that simply the current market price of the options which are traded for that, which are realistically looking at the sentiment, calling out calls and puts based on the fact that, over the period of next 30 days or 60 days, the war is going to end or not. Having considered that, that is where we reverse calculate it and call it implied volatility, which is more forward looking in nature. I'll call it forward looking in nature, forward looking. Whereas the historical data that we consider is more backward looking. What happened in the past is backward looking. What happened in the past is really the building block of how the volatility is calculated. And when we talk about historical volatility or historical data based volatility calculation, there are basically ways for unweighted and weighted thing. Now, as we know how the volatility is being calculated in a real manner, is what we have used x minus x bar whole square by n or n minus 1, which we usually take it in case of stock prices n minus 1, which is sample standard deviation is what we are using, and then we take a square root of it. So this method is basically an unweighted method because all the excess that we have, 1 2 3 4 5, have been given an equal amount of weight. Okay, so this is something which is coming from your quants book. But remember, whenever it comes to the prices or things which are associated with the past, like financial numbers, basically we majorly use sample standard deviation. We don't use population standard deviation because we understand at any point of time we do not have a complete data. So think of it, if I'm evaluating, like, next 5 years forecast based on what the last 5 years forecast or last 5 years prices have been in the sensex or in the economy, I'm not taking complete data because my economy goes as back as, like, 500 years, or even 1000 or 2000 years back. I'm not considering whole of these prices, like Reliance, if I'm taking like 5 year forecast, I'm not considering when it was the first time the company traded, and that is where, 50 or 60 years back, I'm taking the whole price, right? That is where it cannot be considered as a population data. And realistically, what we use in finance is, like, only limited data, past 3 years data, 5 years data, 10 years data, and that's all a reflection of the sample data. And that is where we use sample standard deviation for any calculation here, which is essentially an unweighted method of calculating the volatility. The weighted method of calculating the volatility, and even for forecasting, because we want it to be a little bit, weighted method to calculation of the volatility for today, is done by two methods, and which are the main highlights of this chapter, to be honest. There are two methods. In fact, there were three methods earlier. One, which is arch, has been removed now. So then now we are left with two different models. One is called as EVMA, which is exponentially weighted moving average model. And there is another one which is called as GARCH, which is general autoregressive conditional heteroscedasticity model. Both of them are weighted mechanism, which helps you predict based on the historical prices, which helps you predict for the volatility today. So both of these are helping you predict or estimate for volatility today. Today. GARCH, as the name is longer and it is more comprehensive model than EVMA. So GARCH is a better model than EVMA. Okay, it is essentially a better model. And the other thing that you should keep in mind is, and I'll explain more on this when I take a deep dive into each of these sections, that EVMA does not use what we call it as mean reversion. It does not use mean reversion. Whereas GARCH model assumes mean reversion. Mean reversion. Okay, what is mean reversion? I'll talk about that as well. Just give me a few minutes here. So we have covered the topic on implied volatility as such. Okay, implied volatility, as any other name can be, it is also volatility which can again be scaled up and scaled down, and that is what they have mentioned it here. How do you scale up and scale down? Okay, now I think MDSE is something which is, they've mentioned it here, which is not actually relevant here, to be honest. But since we have started with this topic, I'll cover first the GARCH and EVMA method and the rest of the things, and then probably we can come back to this particular thing on MDE, which is essentially what, which fits in here, as the weighted data component for historical data, which can be used for historical simulation. Okay, so when we talk about GARCH and exponential weighted moving average model, we need to understand how do we calculate for the volatility here. And on that note, let me um, put some equations to it. Okay. So let's start talking about the first model, which is called as exponentially weighted exponentially weighted moving average model. Now, when we talk about this model specifically, we again have a declining factor in mind. Now, what do we mean by declining factor? Because this is a weighted mechanism through which we are saying that, and I'm going to forecast for the volatility for today. Volatility for today. I say that the volatility for, let's say, n minus 1 day, n minus 2 day, n minus 3 day, n minus 4 day have losing significance. The past I'm going, the more backward I'm looking into it, the lesser the relevance. And that is reflected by this lambda as a declining factor. Now, when we come to EWMA, that is where the equation is articulated like this, which wherein it says that the variance, not the volatility, but variance today is determined by the variance which is observed for yesterday, standard deviation square n minus 1, which is the standard deviation which was observed yesterday, plus the returns from yesterday, plus the returns from yesterday. So this is basically saying the variance from yesterday, and this one is saying the returns from yesterday, returns from yesterday. Okay, returns from yesterday. So this is the two important things that we are considering. Now, what is the weightage that we are considering? The weightage is given by this lambda and 1 minus lambda. So lambda and 1 minus lambdas are basically weight. Now, if you think through it logically, what is happening here is we are saying the prices today are determined by what was the variance for yesterday, which I'm giving a certain weight. And then I'm saying the rest of the thing, which is 1 minus lambda, is determined by the returns square observed for that day, returns square from yesterday. And that is helping me determine the variance for today. The variance for today is determined by the variance for yesterday plus a component of returns square, and lambda and 1 minus lambda are simply weights which are uh, helping me put a weight. So 1 lambda plus 1 minus lambda are both weights, and henceforth they should sum up to 1. Now, when we also talk about weights and 1 plus weights summing up to 1, it is also important to understand that the weight that we have assigned to this n minus 1 item here is going to be higher, But the more I'm looking, going beyond that data, that is where the weights should fall. So an alternative way I can write this equation as well is going to be variance for yesterday is going to be lambda times variance for 2 days back plus 1 minus lambda return square n minus 2 days back. The return or the variance for n minus 2 days back is going to be what happened to the variance 3 days back plus 1 minus lambda return square n minus 3 days back, so on and so forth. So if you solve for this equation, put it into it, if you calculate for n minus 2, put that in this equation, calculate for n minus 1, put that n minus 1 into this equation, you get n. In a way, what is happening is the more past I'm going, the more historically I'm looking at things, the more is my um, you know lambda is declining in nature, or a weight is declining in nature, which is also sensible part to what should be done in this case. This model became an instant hit, and that is the model developed by JP Morgan. It was initially developed by JP Morgan in their very famous risk model, which is called as risk metric model. It's still being used, of course, in an amended form, but the model became instantly a hit. However, that being said, it has one major weakness, that this model was not taking care of mean reversion. Now, what does it mean by mean reversion? Okay, let's say in realistic sense, any financial variable, be it unemployment, be it inflation, be it GDP growth, everything moves in cycles. So there are times when things go up, there are times when things go down, then they fluctuate, then they come up, then they come down, then they go up, then they go down, and so on and so forth. So at any point of time, we move in cycles. Not at any point of time, if I see inflation rising to, let's say, 10%, Yeah, I'll keep on seeing it as an increasing pattern. It will reach 100%. So all the economic variables or financial variables for that matter, some of them, like depending on the nature, of course, inflation, unemployment, GDPs are one such cases where GDP growth, especially the percentage things that we associate things with, we say they are not going to look like this. If they're rising, they're not going to be ever rising in nature, or if they're falling, they're not every time going to be falling, and it's going to become negative and even worse and so on. And not things are going to be ever increasing at the same rate, which is an unrealistic assumption, and that is where things don't work in this fashion realistically, and that is where mean reversion is not considered. When we talk about mean reversion, we are talking about things moving in cycles, and that is where we say that there is some kind of a long run average number, long run average number. And financial variables trying at any point of time, even if they go up or down, they'll be attracted to this long run average number. So think of it, if I'm sitting here right now, okay, if I have, let's say, my unemployment level at 5%, then there is some long term average number to which it will slowly shift with economic policies changes and everything. It will slowly come down. But if it's, let's say, 1% right now, if it's 1% right now as an unemployment rate, it will move up and go back to the long run average run over a period of time. So whatever it is, even if you are at the top, you will fall. If you are at the bottom, you will rise, right? That is the bottom line here for a mean reversion concept, because we understand realistically things are always fluctuating around a particular long-term average. Whereas this model, EVMA and GARCH, was not taking care of any such adjustment. It said if things are like, variance is high for yesterday, it's going to be high today. Variance was low yesterday, it's going to be low today. It is nowhere talking about a slow, gradual shift in the numbers which are getting attracted to the long run average. So this was a bottleneck. This was a bottleneck here of this model, specifically the EVMA model, exponentially weighted moving average model, that says that you don't consider mean reversion. This model on a bright side is considered very adaptive model. You don't have to use your mind, you just have to append new data to it, and the model kind of upgrades itself. And that being said, this particular deficiency of this model of not being um, adjusting to a long run mean, or not taking care of the mean reversion, is basically adjusted with this model for the GARCH, with this model for GARCH. With this model for GARCH, we have taken care of this model. Okay, now GARCH uses another equation for representing the same thing, and it has three components to it. First, I'll write down the equation, and then I'll tell you about how do we calculate for this thing. Just understand the logic for now, because this point is very important and is one of the scariest item for any students, because they don't understand the applicability. Why are we calculating things this way rather than going by our usual method, just take an unweighted average and move away? Okay, so assuming the mean reversion that is there, that is where we'll have a formula that the variance of this, the parallel version of this, what we have, it considers three things. One is called as omega, another is called as the variance for n minus 1, and another is the returns for n minus 1. So of course, for these two things which are kind of used again, there is another component which is called as omega. And now we don't talk about weight in terms of lambdas, we talk weight in terms of alpha, beta, and gamma. Alpha, beta, and gamma. And that is where you will see that omega can be written as volatility for a long term multiplied by the gamma, whereas the returns are called as alpha, and your variances are called as beta. So alpha, beta, gamma is again a way through which you can. So this is how the equation looks like in its real form, having alpha, beta, and omega. Omega is nothing but, or I can alternatively write it down as gamma multiplied by the long-term volatility level. Essentially, alpha, beta, and gamma are all weights which are associated with different things. And if they are weights, alpha, beta, and gamma should sum up to 1. So first point is alpha, beta, and gamma should sum up to 1. All three are considered weights. They're put into an equation which looks like this, or I can write it down the same equation. Um as this. For n period, sorry. Variance for n period is equal to V of L gamma plus beta square n time 1 plus alpha r square n minus 1. So now you can feel that alpha, beta, and gamma should sum up to 1. These are all the three weights which are associated. Okay. Now, another point is alpha and beta. Alpha and beta at any point of time, since they're considered weights. Or let me first talk about let's just hold on here. Let's just talk about some models so that you have a better understanding of first what is an AVMA model and a GARCH model, and then I'll continue by taking a deep dive into the GARCH model. So think of it now. You understand how is AVMA model different from a GARCH model. We need to understand how it works in real life, because if you look at it from a real life working example, things will become more easier for you to understand it. So I have a spreadsheet with me on which I've taken some stock prices here for different dates. So as you can see, they are in the increasing order. I've taken prices from you know uh, 25th Feb onwards. There are opening high, low, close, and adjusted close, which I've taken it from Yahoo Finance. And then I've calculated their returns. Now, when it comes to daily returns, because these are all daily numbers, you should always take up the log returns or continuous return, LN P1 by P0. So when I calculated the returns, I've taken LN 197.2 divided by 196.77. And that is where I've calculated for returns. Once I've calculated for returns, I can stretch this column down. F4 by F3, F5 by F4, so on and so forth. So I get my returns. All I need to do is calculate the return square. So once I have calculated my returns in column H, um, yeah, once I've calculated my returns in column H, all I need to do is take a square of this one, because the actual formula that is there for EVMA is I have to focus on two things. One is the return square for n minus 1 days, and another thing is what is going to be the volatility for, or what was the observed volatility for last day. So this is where I've calculated AR square n minus 1, and I've pulled this column down. Now, the second thing that I need to calculate is a variance, because this is the second component that I need. Now, first value of variance cannot be calculated, and that is where the first value will be taken as the same value for the return square. Essentially saying, क्योंकि ये last का data है, ये starting point of my data. Think of it, the last data that I observe for today is this, or not today, but the last day that I'm considering is 24th February 2021. But the starting point is this. So when you start with something, what you do is you take the variance, assuming there was no past variance to it. कहीं ना कहीं तो शुरुआत करनी पड़ेगी ना. You take the variance to be the same number as return square. And once you have done that, that is where you start calculating for the next variance. And how do you do that? Something very, very interesting here. So to calculate for the variance for the next day, like this one, wherein I'm talking about J4, to calculate for this variance, what you need to do is you need to consider the lambda here, and the lambda assumed for this case is 0.94. Now, when you have the lambda with you, lambda multiplied by the variance for last day, which is essentially saying if you look at all this, okay, which is essentially saying SP2 multiplied by J3, SP2 multiplied by J3, sorry, P2, which is lambda multiplied by the volatility for last day by J3. So this lambda 0.94 multiplied by the variance that you see in the yellow section plus J3 plus 1 minus lambda, which is essentially 1 minus 0.06. So 1 minus P2, which is 0.06. Now multiplied with the returns for last day. And what was the returns for last day? These 0.00047649. So volatility. So this is mentioning about P2 is mentioning about lambda. Lambda multiplied by the variance for last day plus 1 minus lambda multiplied by the returns squared for last day. Returns squared. Everything is using square. Please remember it. Returns square for the last day. Once you do that, you are going to get a variance for this number. Okay. Now, in a similar way, calculate for the variance for everything. Okay. Now the question is, how do we get lambda? So I'll just give you one basic question, basic answer for it. And because you don't have to take a deep dive much into it, think of it, this lambda comes from a method which is called as log likelihood method. Okay, you'll have to take a log likelihood as its own formula. You calculate for likelihood, then you calculate log likelihood, and then you try to find out what is the value of lambda that maximizes the log likelihood. Whatever value maximizes the log likelihood is going to be your lambda. So think of it this way, even there is a very complex mechanism, or not very complex, but a complex mechanism to calculate the lambda in real life. But for you, fortunately, as FRM students, you'll not be asked to calculate lambda. All you'll be asked to do is you will be given a lambda value. You will be expected to calculate for the variance for the day. Think of it, you'll have to come up with the variance for any specific day based on the variance what was yesterday. Now, a couple of people ask me, why do we even need to calculate for a variance for a day when I can actually calculate it? Now, think of it this way. When you are a trader, think of it, the markets closed yesterday evening and you have all the data with you. And now you're standing at 9:15 in the morning today when the markets are to open up. So they are about to open up, and that is where you want to understand what should be the volatility for today. You're forecasting for the volatility of today. So you're not sitting at the end of the day for today. And that is where you have already have all the data for that day. You're sitting at the beginning of the day, you're sitting at the beginning of the day, hence trying to forecast or estimate what should be the underlying volatility for that particular day. Okay, so having said that, that is where you have your lambda and your sum of log likelihoods, which help you determine for the variance there. Once you have your variance there, you can stretch it, pull it over here with the same kind of formula, and you will get your ultimate volatility here. So I can keep on increasing this data to whichever periods I want. Ultimately, these are all happening through a declining return. So the highest weight that you will see for any variable will actually come here. The highest weight for any volatility that you will see is going to come here. It's not going to be here, the last value, because it's all declining in nature. Lambdas are all declining in nature. So highest weight essentially comes to the latest item, which in my model is actually 24th February 2021, which is the latest date. So lambda and 1 minus lambda ka weight सबसे ज़्यादा इसी में रहेगा. Now, if you think through it, what happens if I'm placing most of the weight to lambda? That means I'm giving highest relevance to the variance for yesterday using lambda. 1 minus lambda is essentially the lower weight that I'm giving to return. So one way to observe this is lambda and 1 minus lambda with period of time. With period of time, if my lambda is decreasing, think of it, it was high here, it became low here, it became even low here, it became even low here. But at the same time, when lambda was high, 1 minus lambda was very low. And 1 minus lambda in the second period, like first period, I'll call it first period, so on and so forth, because then it becomes lambda into 1 minus lambda. I'll not talk about it, like it's going to be confusing though. Then 1 minus lambda becomes higher here because this is low. And at any point of time, the sum total of these two things should be 1. So if lambda is low here, 1 minus lambda becomes high. 1 minus lambda becomes even high. So as the period increases, as you go more into like latest to older, you know that your lambda is decreasing. Your lambda is decreasing, but at the same time, your 1 minus lambda is actually increasing. Your 1 minus lambda is actually increasing. The weight associated with returns is actually increasing. As you move to the last item in the data set, your returns become the most important item. And that is where we have given the first item, variance, equal weight as return square, saying there is absolutely all the weight going towards return, 100% weight going towards return. This is how things work with the EVMA model, which is exponentially weighted moving average model. Okay.